The S&P 500 closed Tuesday at a fresh all-time high, pushing through the psychologically significant threshold near 7,000 points to mark yet another record in what has now become an extraordinary three-year winning streak. The index delivered total returns of 26% in 2023, 25% in 2024, and 18% through 2025, a performance sequence that historically precedes market exhaustion rather than continuation. Yet as champagne corks pop in trading rooms across Manhattan and passive investors watch their retirement accounts swell with each passing quarter, a remarkable disconnect has emerged between price action and professional sentiment. Recent industry surveys reveal that 79% of North American institutional investors controlling nearly $30 trillion in assets expect a market correction in 2026, with 49% anticipating a decline between 10 and 20%, and another 20% bracing for an even steeper drop. This is not casual bearishness from permabears or doomsday bloggers. This is the quantified anxiety of the institutional class, the pension managers and endowment officers who have watched valuation metrics enter territory seen only twice before in recorded financial history. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. The scale of what we're examining extends far beyond typical market jitters. The Buffett Indicator, which measures total market capitalization against gross domestic product, currently reads 224% as of mid-January 2026, the highest level ever recorded in data stretching back to 1951. This means the collective value of publicly traded American companies is now more than double the size of the entire United States economy, a divergence that Warren Buffett himself once called probably the best single measure of where valuations stand at any given moment. To contextualize this figure, the indicator peaked around 145% just before the dot-com crash in 2000, then surged to approximately 135% ahead of the 2008 financial crisis. The current reading doesn't just exceed those markers, it obliterates them by nearly 70 percentage points. The Shiller price-to-earnings ratio, which smooths earnings over a 10-year period to eliminate cyclical distortions, reached 40.58 in early January 2026. This is only the second time in 155 years of data collection that the metric has breached the 40 threshold. The first occasion was March 2000, when it touched 44.19, immediately before the Nasdaq lost nearly 80% of its value over the following 30 months. The historical mean for this ratio sits at 17.3, meaning the market is currently trading at a 135% premium to its long-term average. Even adjusting for modern accounting standards and the structural shift toward intangible assets, the elevation remains extreme by any historical benchmark. What separates the current environment from ordinary bull market exuberance is the mathematical architecture of market concentration. According to J.P. Morgan Global Research, the top 20 stocks in the S&P 500 now command 50.8% of the index's total market capitalization. The top 10 stocks alone represent nearly 40% of the index weight, a level of concentration that exceeds the 26% peak reached in 1980 and again in 2000 at the height of the technology mania. This winner-takes-all dynamic has effectively eliminated the diversification benefits that made index investing prudent in previous decades. When half of the world's most widely tracked benchmark depends on the quarterly earnings reports of 20 companies, systemic fragility replaces systematic exposure. A single disappointing guidance statement from a hyperscale technology firm, a regulatory probe into artificial intelligence monopolies, or an unexpected slowdown in capital expenditure cycles could trigger cascading effects across portfolios that investors believe are diversified simply because they own 500 different ticker symbols. The mechanisms that created this concentration are deeply structural, rooted in the capital allocation patterns of the past 3 years. Artificial intelligence infrastructure spending by major technology companies reached an estimated $600 to $700 billion in projected capital expenditure for 2026, creating what analysts describe as a circular economy within the tech sector. The largest players became each other's primary customers and investors, funneling capital into semiconductor manufacturers, cloud infrastructure providers, and data center operators in a closed loop that inflated valuations without necessarily expanding the addressable market beyond the technology sector itself. This dynamic resembles the capital misallocation patterns observed during the railroad boom of the 1870s, the conglomerate frenzy of the 1960s, and the fiber optic build-out preceding the 2000 crash. In each historical episode, massive capital formation in a transformative technology created the appearance of unstoppable momentum right up until the moment when return on invested capital failed to materialize at the scale the market had discounted. The paradox of market timing is that participants always feel they have adequate warning, yet historically, they never act on it with sufficient conviction to avoid major losses. The average individual investor, according to the American Association of Individual Investors Sentiment Survey, registered bullish sentiment at 43.2% in late January 2026, well above the historical average of 37.5% and elevated for 8 of the prior 11 weeks. This survey functions as a reliable contrarian indicator, meaning periods of elevated optimism have historically preceded lower forward returns, while periods of pessimism have preceded higher forward returns. Warren Buffett's Berkshire Hathaway has been a net seller of equities for 12 consecutive quarters through the end of 2025, accumulating record cash reserves that exceeded $300 billion. This is not the behavior of an investor who believes current prices offer compelling risk-adjusted returns. When the most successful capital allocator in modern financial history systematically liquidates positions across a 3-year period while markets rally to successive all-time highs, the message embedded in those transactions deserves careful examination. What most market participants misunderstand about valuation-driven corrections is that they don't require a catalyst in the traditional sense. There need not be a Lehman Brothers bankruptcy, a September 11th attack, or a pandemic to trigger mean reversion. Valuations themselves become the catalyst when they reach sufficient extremes. The mechanism operates through forward return compression, a mathematical inevitability rather than an event-driven shock. When investors pay 40 times smoothed earnings for an index yielding roughly 2.5% annually, they are mathematically locking in single-digit annualized returns over the following decade, even if earnings grow at respectable rates, simply because multiple compression from 40 back toward the historical mean of 17 would offset earnings growth entirely. This isn't speculation about whether something bad might happen. This is arithmetic about what returns are available when you overpay for assets. The disparity between price paid and value received eventually manifests, not because markets are efficient in the short run, but because they cannot indefinitely defy the gravitational pull of fundamentals, measured across sufficiently long time horizons. The acceleration of this cycle compared to previous episodes stems from the automation of capital flows and the concentration of assets in passive vehicles. Exchange-traded funds and index mutual funds now control approximately 40% of U.S. equity market capitalization, creating a mechanical bid that persists regardless of valuation. As money flows into S&P 500 index products, it automatically funnels into the largest names in proportion to their market weight, creating a self-reinforcing feedback loop that pushes the already expensive stocks to even greater extremes. This differs fundamentally from the active management era when capital allocators made explicit decisions about valuation before deploying funds. The passive revolution has introduced structural momentum that can persist longer than traditional valuation metrics would suggest sustainable, but it also means reversals. When they occur, face less discriminating sellers on the way down. The algorithm that bought NVIDIA at any price on the way up will sell it at any price on the way down. indifferent to whether the company remains the dominant artificial intelligence chip designer. The human cost of these abstract percentage moves becomes concrete when translated into portfolio impacts across different demographic cohorts. For the baby boomer generation entering or already in retirement, a 30 to 40% drawdown would represent the third major wealth destruction event of their investing lifetimes, following the technology crash and the global financial crisis. Unlike previous cycles where they had decades to recover, this cohort faces the sequence of returns risk inherent to deaccumulation, where early losses permanently impair lifetime consumption capacity even if markets eventually recover. The forced selling from required minimum distributions and living expenses creates a downward spiral distinct from the buy-and-hold recovery available to younger investors. For millennials and Generation Z investors who entered markets primarily after 2009, the entire arc of their investing experience has been characterized by central bank liquidity support and multiple expansion. They have no institutional memory of sustained bear markets or lost decades. The normalization of 14% annualized returns as baseline expectation, rather than extraordinary outcome, creates behavioral vulnerabilities when reversion occurs. The objections to bearish structural analysis typically cluster around three arguments, each of which merits direct engagement. First, that this time is different because artificial intelligence represents a genuine technological revolution comparable to electricity or the internet, justifying premium valuations. The counterpoint is not that artificial intelligence lacks transformative potential, but that transformative potential and current valuation are separate questions. The internet indeed revolutionized human civilization, yet investors who bought Cisco at 50 times sales in March 2000 still experienced 90% losses over the following 2 years, despite the internet's ultimate importance. Paying any price for genuine innovation remains wealth destructive when the price paid exceeds even optimistic discounted cash flow projections. Second, that central bank support will prevent major corrections through continued monetary accommodation. This argument ignores that the Federal Reserve faces a dual mandate requiring attention to both employment and inflation, and that current inflation readings near 3% core leave limited room for aggressive easing without reigniting price pressures that would ultimately prove more destructive to asset prices. Third, that corporate earnings remain strong and will grow into current valuations. The data partially supports this view for the top technology companies, but obscures that the S&P 500 Equal Weight Index significantly underperformed the market cap-weighted version throughout 2024 and 2025, indicating that earnings strength concentrates in the same handful of companies driving index concentration. When the median stock posted only 3.9% returns in 2024, while the index gained 25%, and when nearly half of all U.S. stocks posted negative returns that year, the claim of broad-based earnings strength dissolves under scrutiny. The convergence of multiple structural pressures creates a fragile equilibrium maintained primarily by momentum rather than fundamentals. Margin debt as a percentage of market capitalization remains elevated, indicating that a significant portion of stock ownership is leveraged and therefore vulnerable to forced liquidation during volatility. The junk bond spread, which measures the additional yield investors demand for holding risky corporate debt versus safe government bonds, has compressed to levels indicating widespread complacency about credit risk. When investors accept minimal compensation for lending to speculative-grade borrowers, they signal either that defaults have become impossible or that they have mispriced risk. History suggests overwhelmingly that the latter explanation proves correct. The economic underpinnings show softening labor markets with job growth decelerating and unemployment insurance claims trending higher, reduced consumer sentiment surveys despite continued spending, and concentration of wealth gains among high-income cohorts, creating the K-shaped recovery pattern where aggregate statistics mask underlying bifurcation. At this stage of the valuation cycle, historical precedent suggests we have entered the terminal phase characterized by maximum consensus bullishness and minimum perceived risk, precisely when actual risk has reached maximum levels. The positioning data shows this clearly. Institutional investors expressing concern about corrections, while simultaneously maintaining near-record equity allocations because fear of missing further gains overwhelms fear of losses. This behavior mirrors the psychology documented in 1999 when investors acknowledged valuations appeared stretched but continued buying because momentum remained positive. The difference between prudent risk management and panic is that prudent risk management occurs when markets feel safe and prices are high, while panic occurs when markets feel dangerous and prices are low. The current environment offers the former opportunity, yet most market participants will wait for the latter scenario, at which point preservation becomes impossible and recovery becomes the only option. The forward-looking transition to the next phase of this cycle depends less on predicting specific timing than on recognizing the mathematical constraints that govern mean reversion. Once valuations reach 2 to 3 standard deviations above historical norms across multiple independent metrics simultaneously, the probability distribution of forward returns shifts decisively negative for intermediate time horizons between 3 and 10 years. This doesn't mean markets cannot move higher in the near term. Momentum can persist beyond rational timeframes, and speculative excess frequently climaxes in parabolic moves that feel like validation to participants. But the setup ensures that however high prices eventually peak, the subsequent adjustment will be proportional to the excess that preceded it. A market trading at 40 times smoothed earnings doesn't gently deflate back to 17 times over a decade while earnings grow. It reprices violently when the bid disappears and reveals that much of the apparent wealth created during the expansion phase was ephemeral, representing mark-to-market gains on positions that cannot be liquidated at prevailing prices once selling begins in earnest. The institutions managing $30 trillion who expect corrections in 2026 understand this dynamic, even if their public positioning suggests otherwise. The gap between what professionals know and what they're positioned for reflects the career risk of being early more than analytical uncertainty about direction.